Pump and dump is a fraudulent scheme commonly associated with stock markets, but it can also occur in other financial markets, such as cryptocurrency and penny stocks. In a pump and dump scheme, individuals or groups artificially inflate the price of an asset through false or misleading statements, hype, and coordinated buying activity at the pump, before selling their holdings at a profit once the price has reached a peak, the dump. Here's a detailed explanation of pump and dump schemes. Pump phase. During the pump phase, promoters or insiders actively promote a particular asset, often through social media, online forums, newsletters, or direct communication channels. Promoters may disseminate false or exaggerated information about the asset's prospects, such as upcoming partnerships, product launches, or revenue projections, to create excitement and attract investors. Pumpers may also engage in coordinated buying activity to artificially inflate the price of the asset, creating the illusion of strong demand and upward momentum. Hype and FOMO pump and dump schemes rely on psychological tactics to manipulate investor sentiment and behavior. Promoters capitalize on investors' fear of missing out, FOMO, by exaggerating the potential gains and creating a sense of urgency to buy the asset. Hype and excitement generated during the pump phase can attract unsuspecting retail investors, day traders, or speculators who seek quick profits and are susceptible to herd behavior. Dump phase. Once the price of the pumped asset has reached a peak, promoters and insiders begin selling their holdings at a profit, often in large volumes and at inflated prices. The sudden selling pressure from insiders triggers a rapid decline in the price of the asset, causing panic among investors who bought in during the pump phase. As the price plummets, latecomers who bought near the peak suffer significant losses, while pumpers exit their positions with substantial profits. Victims and consequences. Pump and dump schemes primarily target retail investors and inexperienced traders who lack the knowledge or resources to conduct thorough due diligence. Victims of pump and dump schemes may suffer financial losses when the price of the pumped asset collapses, leaving them holding worthless or heavily devalued securities. Pump and dump schemes undermine market integrity, erode investor confidence, and tarnish the reputation of legitimate assets and investment opportunities. Regulatory response pump and dump schemes are illegal under securities laws in most jurisdictions, as they constitute market manipulation, fraud, and securities fraud. Regulatory authorities such as the Securities and Exchange Commission, SEC in the United States, actively monitor and investigate suspicious trading activity, pump and dump schemes, and other forms of market manipulation. Penalties for individuals or entities involved in pump and dump schemes may include civil enforcement actions, criminal charges, fines, disgorgement of ill-gotten gains, and imprisonment. Red flags and warning signs. Investors should be cautious of assets that experience sudden, unexplained price spikes or extreme volatility, especially when accompanied by promotional hype or social media buzz. Red flags of pump and dump schemes include unsolicited investment recommendations, unrealistic promises of guaranteed returns, lack of verifiable information or financial disclosures, and pressure to buy quickly before missing out on an alleged opportunity. In summary, pump and dump schemes are fraudulent tactics used to manipulate financial markets and deceive investors for illicit gains. Investors should exercise diligence, skepticism, and caution when evaluating investment opportunities and be wary of schemes that promise unrealistic returns or rely on hype and manipulation tactics.